driven?
Yes.
Okay. Do you have any problems getting approved at all to
For
take
this
it up here?
class,
Yeah.
I really did.
Really?
There's another class that I wanted to take in spring of 2 this semester, and they would not allow me to do it because I've already taken 2 online classes as well. But then my advisor, actually like a week ago, no joke, told me I had one more class that I needed to graduate this spring that she forgot to tell me about, and now I can magically take another class this spring. And it's because it's cheaper and they want more money, which I understand. But I'm not a veteran, so that's why. And that my boyfriend's a ranger and my brother is special forces, but that doesn't qualify you to take classes.
Right.
And I was like, well, we're not getting married, so I can take the class, I can tell you that much. So, but they let me do it, and then now I am taking a spring of 2 class, but not the one I wanted to. A different one that I didn't even know I needed to graduate, but I'll be done this spring. So
Okay.
that's what matters.
Yeah, I've just heard combinations of it's painful to I've had no problem, and it seems to be driven by the advisor as much as anything
I was
else.
just about to say, well, I am not, I'm going to say my advisor did not make it easier. That's the extent of what I'll say.
Okay.
Yeah. But I did talk to other professors in the business department who were really great to me and made it a lot easier. But my advisor did not make it.
Okay.
Heather Grove was awesome.
I like Heather,
Yeah.
but that's because she's a Notre Dame grad too. So
Right. I think you know my uncle, Dick Roney.
I do.
Yeah.
Poor Dick. He knows me too.
It does not sound like you've had a history of like being the most welcome person when you go anywhere, right? Not if you're going to somewhere that's like financially in trouble and you're the guy who has to say, you gotta go, we're keeping this.
No, it's not been
Right.
ideal.
You have the tough conversations, right?
Yes. Although I don't want to say you get used to it because you never do, and you know you're impacting people.
Right.
But ultimately, you also look at it and go, hey, I'm saving a lot of jobs. Hopefully, we're able to make a turn or a change, and you try and be as transparent as possible around the decision-making process, and things tend to go okay. Not always, and you know, it's not been always been fun. But like here, we did no layoffs at St. Martin's. We ran into
No, yeah. I wasn't necessarily talking about here.
I had the hardest time getting into Math 201.
Really?
Well, just the time I needed it, like last year, it was offered once for the year or something, and I don't remember what the deal was, but I had a problem taking it, and then I actually take it. This is the third time taking it because the first time I didn't have time to do it, and I didn't realize about the full drop process. I didn't get enough to it, so I failed it basically.
I had one of those as in my MBA too, where I was like, oh, I missed the drop window. Oops.
And now it's up to you not for all the time, and I'm in it right now, but
201 is not an easy
I think 161 was all I was required to take as a business marketing major.
That's a quant methods.
Yeah.
the statistics. So it's now quarter after, so I'm going to have 2 of the 7 of you here, and then maybe Milana on Hangout. So this will be relatively easy and straightforward. What problems did you guys have?
Yeah.
What do you want? What do you want to go through? Let's gotta dig in.
What is your define on the quiz with these problems? And I understood the reading, but like, what's the simplest way to understand modified internal rate of return?
What's the easiest way to understand it? Let me pull up the. I'm going to pull up. I'm going to go to handy dandy. The difference between internal rate of return and modified internal rate of return is really the assumption at what the cash flows are reinvested at.
Right.
So I'm going to see if Google can help us with their definition before I. I guess this isn't all that helpful. So let me give a brief example of how I think about modified internal rate of return and why I tend to use it as kind of the standard.
Right. Because that's what I was taking from it, was that it like is the preferred.
Yeah. So when you've got a project and you're looking at a project and you use IRR and you calculate out, let's say that you've got a project and your firm's cost of capital, weighted average cost of capital is 13%. And you've got a project and you calculate out the cash flows, and the cash flows result in an IRR of 14%. I'm going to make it close on purpose, or 13.2%. Your initial inclination on IRR, the assumption is cash flow from period 1 is reinvested in that project and gets reinvested at 13.1 or 13.2%. And then in that project at 13.1 or 13.2%. In reality, what's likely to occur is that project is generating cash flows and spinning off cash back to the company. And the company takes that cash and goes, well, I have to reinvest this in another project and pay it out as a dividend or what have you. And so it probably can't reinvest it at 13.1 or 13.2%. It may be, okay, I've got, the weighted average cost of capital is 13. I'm going to calculate it at 13%. So it comes off the initial project at 13.2.
Yeah.
And then you don't get to keep that extra 0.2% for the life of the project. You really go, okay, I'm going to assume for a moment that the initial cash flow of this is going to be reinvested instead of at the original what the project return is. It's going to be reinvested at the weighted average cost of capital. What you may then find is that 13.2 becomes close to or even below the actual required rate of return, because you've got something in an out year that will tend to cause the modified internal rate of return actually be lower than the required rate of return. So I've tended to use MIRR, modified internal rate of return, because it's a more conservative assumption. It's assuming that any profit or any cash flow off of that project is going to be reinvested at the corporate average rate rather than at that project's rate. And you can have a project that's got a ridiculously high rate of return, 150% IRR. But if you use modified internal rate of return, it's going to drop to 60 or 65 or 50 because your weighted average capital is 15. It's going to go, okay, that first period I got a 100% return on my dollars, and then
because I calculated it out for the remainder of the life, it's only going to be 15%. Does that make sense at all? Was that more
So what
clear
I'm
as well?
taking away from what you said is that by being more conservative and using the modified IRR, then it's kind of like a bonus a little bit. In my mind, like this, I'm trying to
Yeah,
process
no,
what you're saying
yeah.
a little bit. So like if you're putting it at that 65% rate of return as opposed to 150, then that extra 75, whatever it is, percent is like bonus. Or it's like, instead of like over assuming,
Yeah, it's probably,
it's just standardizing it across the organization or company.
yeah, think about it this way. This might be a better, as I'm now seeing how you're thinking about
Yeah.
it, think about it this way. You're trying to figure out what the real rate of return is on this project. So if it's the 65%, because it's a modified internal rate of return, that's me going, hey, I did this project, and I'm assuming a worst case of any dollars coming out that project, I'm only going to reinvest at the corporate average return. But I'm going to get a value on that reinvestment. So the money's going to come off this project, and I'm going to reinvest it at the 15% corporate average, weighted average cost of capital. And so over the life of this project, my rate of return is 65%.
Right, okay.
That's if you use modified internal rate of return. Because you're assuming that the cash flow is going to be reinvested, but only at the weighted average cost of capital. It's your real rate of return.
Yeah.
The IRR assumes it's going to be reinvested at the same rate of return as the project.
Okay.
That's probably too aggressive because you may have this project that is fantastic. You know, it's a once in a lifetime, triple digit annualized rate of return project. But you're not going to be able to reinvest at that. You're only going to be able to take the profits from that and reinvest it at the weighted average cost of capital. So that's probably a more realistic measure of what the return to the shareholders is going to be over time, is going, yeah, I got a great project and then I'm reinvesting it in the company as a whole. Rather than I got a great project and I'm reinvesting it in another great project.
So calculate as a standard as opposed to the exception, because over time it's on the average after the same.
That's a great way to summarize it.
Okay.
Is really you're going, I'm assuming that my next project is going to be at the mean.
So,
over time,
so then you would use IR if you just did want to see what it was for that one.
For that
project.
one particular project, and you're assuming that you're reinvesting all the profit from that project back into the project.
Okay. Okay.
If you're going to reinvest the profit from that project into the company as a whole,
Yeah.
then modified internal rate of return is going to give you a more accurate picture of that.
Okay. And that's for at the corporation level.
Yep.
So like a private entity, they might prefer the IRR because they have smaller projects and.
No, it's really, can I reinvest that money in the project? Or is it money going to be, is the profit from this project going to be reinvested in a similar project or the same project to grow it at that same rate of return? Or is it going to be invested in some other project, the company as a whole, where likely I'm going to only invest it in a project that's going to have to meet the corporation's weighted average cost of capital, so it's going to be lower.
What if the project spanned over multiple years?
Wouldn't change the analysis.
No. Okay.
It's so clear as mud.
Yeah.
But
Yeah, no, it helps me like think through it and conceptualize it a little bit better. Yeah.
What else?
This isn't necessarily pertaining to the specific chapters that we have, but a
That's
lot
fine.
of questions that have come up, and it talks about it with the financial manager and how the financial manager is not the CFO, or is the CFO?
Could be.
Okay, so I'm trying to like think about like an organization and like where they fit into the puzzle piece. And,
Yeah.
And why? I think I kept getting the question wrong, like back on the first test. Was like, what is the financial manager's main responsibility? And I said it was to like maximize the profits to the shareholders or something like along those lines. I can't remember exactly what it was. If that was incorrect.
I'd have to look at the other choices to determine what the correct answer is.
I might have it in here.
Okay.
I keep track of one thing wrong. But you can explain more where they fit into like an org structure.
Yeah.
The responsibilities.
Yeah, it normally would be.
I'll pull up a typical org chart. Give me a second.
Okay, I have the question. Which of the following should be the primary goal pursued by the financial manager of the firm? I chose maximizing the market value of the firm's stock, which is incorrect, and the correct one was maximizing dividends paid to the common stockholders. So,
What were the other choices?
minimizing variable operating expenses, maximizing net income or profits, or maximizing firm's net worth or book value.
Okay. Interesting. I would probably agree with your initial answer.
The market value
Um,
of the firm's stock?
maximizing return to the shareholder.
Okay, that is the correct answer.
That's the correct
That is
answer?
the correct answer.
Okay, because you said dividends, so
I said that when I first responded to you, because I think I was getting confused
Okay.
what I got wrong and what I got right, so.
okay, so it should be maximizing return to the shareholders. And let me explain. So here's a typical structure, corporate structure.
Right.
And your finance manager is generally going to be
The
a
CFO.
CFO. In some companies, they don't have enough people for it to be a CFO, so it could end up sitting with a controller, or it could end up being the president doubles as the chief financial officer. As a bookkeeper.
That's how it is at the company I work for. Yeah.
The president serves as a CFO, and you've got a bookkeeper, or there's a controller. Okay.
Yeah.
So the job of the finance person is essentially to go, hey, how do I maximize value, maximize return to the owners? And return is measured in two ways, and we talked about it a little bit last class. It's dividends, and it's capital gains, essentially the increase in stock price. And so there's a bunch of factors that go into the value of the stock price, but it's essentially capital asset pricing model. So you got a risk-free rate plus a growth rate and a dividend rate, and those all combine together to come up with a stock price. And then you've got dividend policy, which is your current cash flows that go out. And so your job as a finance manager is to go, okay, how do I essentially optimize the value? So get the highest return for the lowest possible risk. Because when you think about risk and return, risk is measured in terms of interest rate, right? The value of any financial asset is a combination of its cash flows plus the interest rate. And so if you're able to drive risk down, it drives the interest rate down, or the required rate of return down, which does what to an asset price?
The interest rate goes down?
Yeah, if the R goes down, the required rate of return goes down, what happens to the asset price?
Okay.
Goes up. I'll show you an example. Let me show you an example, because I might not be, I'm doing one day. So I might
Me too.
I might not be all that articulate right now. So let's look at a value of perpetuity, because it's easy. So you've got $100. Let's see. If this will work. It's probably a permanent marker. You got $100, and you got a required rate of return of 10%, and it's a perpetuity. What's the value of a perpetuity?
The par value, right?
Well, no, not the par value. What's the asset value? I know I didn't ask you to memorize any formulas, but do you have this one memorized?
No.
Okay. The present value of a perpetuity
Yeah.
is the cash flow, periodic cash flow over the discount rate.
So $10, is that?
So in this particular case, you've got $100 a year that's paid over 10%. So the value of that perpetuity is $1,000. So if I said I was going to give you $100 a year forever,
Yeah.
and your required rate of return was 10%, you would be willing to pay $1,000 for that right. If that number drops So that required rate of return drops from 10% to 5%.
Yeah.
What happens to the value of that perpetuity? Does it? Let's do the math. Cash flow doesn't change, right? It's still $100.
Right, and then 5%.
What does that turn into?
5,000. Or, right? Or 2,000.
So what happens when the interest rate, when the required rate of return falls? The asset price does what? It goes up. And so if you're able to, as a finance manager, reduce the risk, let's assume this is stock for a moment.
Yeah.
If you're able to reduce the risk so that the required rate of return on your stock goes from 10% to 5%, and you're able to keep the cash flow steady, you're then able to increase the value of the firm. And so what you're trying to do as a finance manager is optimize this equation. Essentially go, and again, it's a dividend discount model, but you're essentially looking to optimize that equation. You're going, okay, how do I maximize the value of the firm by minimizing risk and maximizing cash flow? And essentially you can plot the various components of risk, cash flow, and value, and you come up with this thing with a graph that looks like this, an efficient frontier, where you go, okay, I'm going to look for the optimization point, essentially the point at which the required rate of return and the cash flow are optimized to a certain value. And because at some point the risk starts going up faster than the cash flow starts going up, or the risk starts going down faster than the cash flow starts going down faster than the risk starts going down. And so you use calculus to essentially determine the point at which that curve, so you come up with an equation for the curve, and you use your first derivative to go, okay, at which point that is zero, that point is going to be your optimization point, or an optimization point.
So thinking like past that optimization point on that curve, are you willing to take more risk because you're not going to be hurting the cash flow as much? Because it levels out more over the top. So once like this is your stopping point. So past this, like you can take that more risk. It's not going to hurt the cash flow as much.
Yeah, the way that that's drawn, you would argue that right about here, where your curve is basically, well, this says risk starts to drop off here,
right,
and cash flow is higher. It's probably it is permanent market.
It's a good picture, so that people will want to see that.
I was like, it's got to be permanent marker because it works.
There's a purple marker behind your laptop if you want.
So yeah, if you have a regular marker, you can.
Yeah, I can use it as the
scrub off.
Yeah.
Working.
You know what? Every teacher that I've had in this building cannot find markers around the board. So they're all dead, I swear.
Well, that one's not dead.
Oh no.
It'll be there for weeks.
Perfect.
Yeah. Well, you know what? Now people are going to know what perpetuity is, so they're welcome.
I have a question. It's okay. So in my company last year, they pretty much halted overtime. We were going 50 hours, 55, 60 hours a week, and it was open overtime. Then all of a sudden, about October, they squashed all the overtime, right?
Okay.
Across the board. And then in January, they laid off about 5 to 10% of all the employees.
Okay.
And so that's along the lines of what you're saying. Because if the cash flow isn't going out as much because they're not paying as much overtime, and they're probably trying to maximize the value of the company. And then, of course, they lay off all the people.
Sometimes, I mean, you may be looking at a much more micro. That ultimately, the decision should have been made with this in mind. Okay, how do I maximize the value of the company? Well, right now, I'm not getting enough of a return on the dollars I'm spending on this additional overtime. And so I need to reduce my variable costs. And so I'm going to look at a point at which essentially marginal cost equals marginal revenue from an economics perspective. And if my marginal revenue isn't rising, if I've basically passed the marginal cost curve, and again, that's another calculus thing where you're essentially taking the first derivative of your cost curve and the first derivative of your revenue curve and going, okay, basically where do the two equal? Where are the two at zero? So that the change in revenue and the change in cost are equal. At that point, you're basically going, okay, I shouldn't spend any more costs because I'm not going to get enough additional revenue. I'm going to start losing money on volume. And so they may have taken a look at it and said, we can put you guys on overtime and produce more widgets. But the incremental widgets that we're producing aren't going to make more. Our cost is going to go up faster than the revenue is going to go up. So we shouldn't do that. And so they probably did some analysis like that if they were like book smart. A lot of companies don't do that level of analysis. They operate off their gut instincts, or they pull it out of their fourth point of contact, and they go, okay, well, this doesn't feel good, so we need to cut expenses, so cut overtime. They haven't looked at, okay, what's the marginal revenue implications of cutting overtime, for instance? Or we lay off people, what's the marginal cost associated with having to train additional workers down the line? Or the marginal cost, what are our alternatives? Can we reduce hours to 30 hours a week for everybody as opposed to laying off 10% of the workforce? Can we, cut hours by 10% across the board and then keep a well-trained workforce on board for a little bit longer? Of course, then you've got benefits and other considerations. But generally, it's going to be the driver behind that decision should be this decision, which is what's the primary responsibility of a financial manager? To make recommendations to management that will optimize the value of the firm. And how do you optimize the value of the firm? You look at all these components, including the basic economics components, and go, okay, marginal costs are going up faster than marginal revenue is. We need to reduce marginal costs. How do I do that? Well, I'm going to cut overtime. Does that make sense? Okay. It's hard to tell kind of in the abstract. If I had the financial statements, I could probably look at it and go, yeah, this made sense, or no, it didn't make sense. A lot of times, the reason overtime exists, overtime was put in place under the Fair Labor Standards Act back in the 30s. And the reason overtime exists is to force companies to hire additional workers. So it was put in place during the Depression to stimulate hiring. So they said folks used to work 60, 70 hours a week. And the president, Roosevelt at the time, said, I got 30% unemployment. We got to put people back to work. And so I'm going to make it very expensive for you to work somebody over a 40-hour work week, so that way it then is cheaper for you to go hire somebody else and put someone else back to work. That's why.
Like 8-hour work days are long days.
They are. I'm going to be going on a 12-hour work day today, so it's.
Yeah, no, I've been up since 5:30.
Yeah, so it's and the issue, the purpose is really to prevent exploitation of workers and to force companies to take a look at things like overtime and go, okay, we're going to cut overtime and hire additional. No, not cut overtime and lay people off. The thought was, we can have people cut overtime. If you have 40% of your people working, 10 hours of overtime, it's cheaper to then hire another 10% or 15% of people.
Or move them to salary and only hire 5%.
Yeah, although that's generally illegal. The Fair Labor Standards Act has relatively strict rules around who qualifies as an exempt employee, exempt from overtime. And the Department of Labor will enforce those. As a matter of fact, at St. Martin's University, we had a Department of Labor audit about a year and a half ago where they came in, took a look at every stinking employee and said, what are their duties? What are their responsibilities? Should they be entitled to overtime or not? And in some cases, we had misclassified employees where we said, okay, those employees are, like, use the HR, there was a HR director, exempt. There was an HR manager who, when they looked at the duties, they said, no, she's doing more clerical work than manager work, so you have to pay her overtime. And so they'll actually come and look at it. So it's somewhat difficult to be
So you
considered
can still
exempt.
pay overtime on a salaried employee, or you
Oh,
can
yes.
to hourly?
No, you can be salaried, non-exempt.
So how would that work?
So for your first 40 hours,
Yeah.
you're paid your salary.
Okay.
And after your 40 hours, you're then paid overtime, time and a half,
Yeah.
based upon your imputed hourly rate from your salary.
So you don't want to be an exempt salaried employee.
Well, I'm an exempt salaried employee. I kind of want to be. I would rather be an overtime paid employee, but I comfortably fit within the exemption. A lot of people teachers fit within exemptions. Teachers, professors, adjunct professors, coaches, they all are exempt from overtime. But many of your rank and file employees, to include financial aid advisors, registrar's office, at the university, student affairs folks, they're all hourly or salaried,
Right.
non-exempt. And so once they go over 40, we have to start paying time and a half for overtime.
So what about someone who has like a traveling job?
Are you in sales or not in sales?
Training.
Training, it depends. It depends on the duties.
I don't know if that makes a difference.
Is it a state job?
No.
Okay. So state, we're kind of off the reservation.
I'm actually, because I
That's
just
okay.
I'm interested.
Okay.
I just got a new job last week, which is
Congratulations.
Thanks, but I haven't gotten my official offer yet, and I know I'm hourly right now, and I know they're going to move me to salary, and I'm anxious to know how I should approach whatever offer they officially give me, which I should have gotten today, but now I'm going to tomorrow.
I was about to say, I'm happy to, if you're down, Lacey, I'm happy to sit down with you and go through it too.
Yeah, I would actually
Because
really, really.
206 Old Main swinging,
Yeah.
swinging in there. But essentially what you're looking at is, if you're in a sales position,
Yeah.
they're generally exempt. So if they look at it and they go, okay, your position is predominantly sales. So you work for company X and you go to state agencies and you sell software, or you sell training, or you train, or you do that, then you're considered an educational employee, or you're considered a sales employee, you're exempt. If you're commissioned, you're exempt. If you're in a situation where you're in sales support, let's say, so you're out and your compensation isn't driven by your ability to sell or not sell, and you've got a job where you're expected to be at work at time X and you're done at time Y, and so your day is highly structured. They'll look at the combination of the bulk of your duties coupled with what your schedule looks and feels like, and they'll go, okay, you're non-exempt. You may be salaried, but you're salaried non-exempt, and any hours over 40 you need to be paid a time and a half. And travel time then becomes compensable to the extent that it's non-commuting time. And so there's all sorts of arcane, bizarre rules around what travel time is compensable, what travel time is not compensable, whether it's overtime or not overtime.
Is that per state? So then it's like whatever state.
Each state has its own rules as well. So there's the Federal Fair Labor Standards Act,
Yeah.
which governs everybody.
Right.
And then some states like Washington have more strict rules. California, more strict yet. So California, say Washington and the federal government say 40-hour work week. Anything over 40 hours becomes time and a half for overtime. California, 8-hour workday. Anytime over 8 hours in a day becomes
Yeah, I
overtime.
like that. I like that.
As an employer, I didn't like it.
That's how my wife is. She works in the hospital, and that's how she is. So she works 9 hours today, 1 hour overtime, and then she's worked a total of 40 hours. That she gets paid 39 regular hours, one hour overtime.
She union?
Yeah.
Yeah, so during union, we'll collectively bargain that pay with the employer. So you can always negotiate for compensation above and beyond what's required by law. And so at a union shop, the union's job is to maximize essentially the value of the labor hours worked by the workers.
And so their job is to represent the worker in that case and go, hey, we think as part of this new contract that anybody working over 8 hours a day should be paid time and a half for overtime. It should count for overtime, regardless of Washington state law. And that becomes part of the collective bargaining agreement, and it governs that employee-employer relationship in that particular setting is governed by contract as opposed to by statute, as opposed to by state law. And so in your particular case, Maria, you may be in a job that is.
I'm going to be traveling at least once a month, 3 to 5 days at a time out of state.
Okay.
We have 40 out of 50 states, so we'll be all over the US.
Okay. So in some cases, your travel will be, if you were on the job and you're traveling and working while you're traveling, then it's compensable. If you were not working while you're traveling, it's not compensable. So for instance,
So like Monday was the travel day and I had no training, but Tuesday was. So Monday is either work remote or.
normally they would say, and again, I'd have to look at it. I'd have to look at each specific instance and then cross it against the law. But in general, what it would normally say is, if you're salaried, exempt, it's a work day, and you're paid a full day's wage. If you're salaried exempt, whether you're working, not working. If you're salaried exempt. The benefit to being salaried exempt is if you work an hour, you worked and you get paid for the day. If you work 14 hours, you worked and you get paid for the day. If you're non-exempt, they look at, okay, you have commuting time from the airport from your home to the airport, that's not compensable. You have waiting time at the airport, may be compensable. During your normal working hours, you'd be considered working. And so they go, okay, if you're traveling during normal working hours, you'd be considered working. If you're traveling after normal working hours and you're available to work, you'd be considered working. If you're not available to work, so you're sleeping or you're off for the day, and then you're not considered working, even though you're remote at the employer's convenience. And so it really becomes one of those. Normally, you don't have a lot of hourly folks traveling. A lot of times.
Yeah, certain areas take me off hourly, and they already told me it'll be an incremental increase as I work my way through their standards for training.
And it really is it would be the duties that you're responsible for while you're out on the road would determine whether you're hourly or salaried. So it's the duties that you perform. And there's a big circular that essentially, it's a Department of Labor circular that basically lays it all out, the regulations. At the end of the day, the other side of it is you can end up being and both. So you can end up having a job where when you're in the office, you're hourly, and when you're traveling, you're salaried, because you've got a job that's 50% training and 50% administrative. And so they go, when you're doing training stuff.
You can negotiate that?
It's not just negotiated, but the law you can say that.
Oh, okay.
So I've got employees, for instance, where they work 50% of their job is, I'll use a lacrosse coach.
Right.
And 50% of their job is they're the custodian for the pavilion. The 50% of their job where they're the custodian for the pavilion, to the extent that they're working at that job, they're hourly. To the extent that they're working at the coaching job, they're salaried exempt. And so it becomes two jobs essentially, and they're paid almost separately, and hours are tracked separately for each.
Well, it doesn't seem like it's an option to be non-exempt if you're traveling.
Oh, it is. And there's, so for instance, let's say you were I'm trying to come up with a logical example. You were the secretary to the chief executive officer of the company you work for.
Right.
And she takes you wherever she goes, because she needs you to continue to answer emails and phone and kind of do whatever she needs you to do on the road. At that point, you're traveling and you're still hourly. But when she says, we're done for the night, I'm going off to dinner with some sales dinner, and you're done for the night, and it's 4:00 in the afternoon, and you're off, the clock stops even though you're sitting in Phoenix. So you don't get paid 24 hours a day just because you're on the road. It's really when you're physically working.
And so it could be one of those where if you're at the employer's convenience sitting waiting for work, so she goes, sit here, wait here, I'm going into a meeting. As soon as I come out, I'm going to need you to do X, Y, and Z. You're sitting there twiddling your thumbs waiting, you're getting paid.
Right.
If she says you're off and I'll see you in the morning, you're not, the clock stops. And so when you're traveling, there's rules around when clocks start and stop. And some of that is whether you're in transit or not, whether you're waiting for transit or not, whether it's your normal commuting hours or not, whether it's your normal work hours or not. But at the end of the day, normally folks who are traveling are sales folks and executive, and so they tend to not have.
Right, and they get bonuses or commission or something.
Well,
right, to help incentivize their efforts when.
I'm salaried exempt at St. Martin's. I don't get bonuses or commissions. In my prior life, I got bonuses. Based upon corporate performance, but I've got it's a different world at St. Martin's, so we don't have bonus structure, commission structure. But I can tell you that, like, I don't get paid to teach either. But I can tell you that, that there's other opportunities for, you're not. Most people at St. Martin's ain't doing this for the money.
Right.
We're doing it because we care about the mission. But yeah, it's. In many cases in the real world, folks are the compensation is such that folks go into a salary, they go into a salaried position knowing that, the compensation's higher, and I'm going to have to work overtime some days. And if you have a decent boss, your boss is also going to go, okay, I need to give her some time off as well because she's worked 40 hours, 50 hours, 60 hours last week. So I'm going to tell her to take off early on Tuesday for a few hours. You have a doctor's appointment, then you're paid time off and that kind of stuff. And that's normally how salaried folks operate. You work for an hour, you work at all you work for the day. And so like at St. Martin's, for instance, if we have someone who comes in and they're salaried exempt, like if I had a dentist appointment in the afternoon, I don't have to take sick time for the dentist. I get paid for the day. But there's an expectation that over the course of the year, I'll work 2,080 hours or more. Well, there's an expectation I'll work 2,080 hours or more, or at least 2,000 hours if you get 2 weeks of vacation, which is 80 hours.
Well, I appreciate you talking about this. It's obviously not completely related to the class. But
no, but fortunately or unfortunately, there's only 2 of you here tonight. And as we said at the beginning, this is kind of the flipped classroom structure. So I'm going to answer your questions, whatever's kind of coming up, and make sure you understand, because all this is, it's finance tangential. It may not be finance centered, but I also want to be responsive to what you guys need from you're paying good money to be here at St. Martin's, and you'll get through the class. It's really a question of how can I help you guys get a solid education as part of it. So what other questions you got?
I wrote down 2 questions, or I put out 2 questions that I missed on the test, but as we're talking, I was kind of figuring out the process of doing it. So I'm really good. I don't really have a question on that.
Okay.
I just missed. I didn't pay attention enough. I was switched on time, and I did that. I redid the first test, I redid the second test, and then when I was going over this information, I went too fast or whatever, so I just need to go back through it again. Yeah. Oh, I have a question about the test, the final test though. You said it's open book or not?
Yep.
So
open book, open notes, open internet, open everything.
I'm in the process of fixing this old computer. Well, I'm getting it where I can just use Excel on it.
Mm-hmm.
I don't need the internet necessarily. I just use Excel on it. But if I cannot get this working, can I be using computer from a room computer lab or how the?
Yeah, give me if you're at that point, I normally bring a laptop or 2 with me. Okay. So between next door or mine or my spare, we'll make sure you're squared away.
Okay. This next Monday is the midterm, correct?
It's due, correct.
It's due next Monday.
Yeah,
Yeah.
we only get 2 attempts. That's what.
Yes, you only get 2 attempts at the midterm. So that's looks like Lacey. That's
The current test
Lacey.
is due by tomorrow night, right?
Yep.
I need it for you.
So next Monday, no class because it's President's Day. So the university is closed, base is closed, and it is due next Monday midnight. And I'm going to submit to the registrar tomorrow midterm grades because I have to. Just again, it'll just be a reflection of the quiz. Basically, the quiz that was due today. So the quiz through chapter 10. So you'll have 3 grades going into the midterm, and it's just going to be 1/3 weighted to come up with the grade. If anybody's in trouble, you'll get an email from me, and I'll let you know, hey, let's make sure that we're on track. But in general, there should be no surprises since you know what your grades are going into tonight. What other questions? Any other morbid curiosities around how business works, how your offer letter's going to look, what the...
I'm anxious to get it because it's going to be like a full-on transition plan, so we'll see how it's going to work.
So is it the same employer and you're changing jobs?
Yes.
Okay.
So we have like 3 products, software products that we have, and I work on the emerging solution side, which is failing. It's not emerging. So I'm switching over to our legacy product, which is called Aware Enterprise, and we work with state agencies, and it's a vocational rehabilitation software, case management software. So for the blind, and help integrate them into the workforce. So I'll be working with the counselors and teaching them how to use the software. And some of the counselors are handicapped or blind themselves, so it's jobs accessible. And so I'll be working with them with that as well.
Okay.
That's actually so that's where my question about the risk came from, though, is because so we work with state agencies, and once you hit 50 states, there's nowhere to grow. So that's kind of why they created this whole emerging solutions part of the company, and they started it up about 3 years ago. I've been with the company almost 2 years now, and we were just not getting customers out of this product they created. And the methodology for this product, it's a goal management software. The methodology came with the CEO, and he used Excel originally with it, where you build your quarterly objectives for each team, review with your managers review with directors with your C-level. It worked great for him, and there's all these progress stages through each of these objectives, and they all tie up to higher level goals. And then the owners who brought in the CEO, so before the owners were the CEOs and running the company and all worked in the company. And there's 6 of them, and 4 of them, there's about 7 of them, and 5 of them work in the company at the top levels. And some of them are unique and very opinionated, but they've all fallen in love with the methodology. So being developers themselves, they created a software based off the methodology, and it's like become one of the owner's babies. And he will not let it die. And it's just like no customers, no revenue, and a lot of money.
It's sometimes hard to tell someone their baby's ugly.
Yeah. And so we're just next quarter we'll release 3.0, so the 3rd iteration of this software. And we like barely have 3 customers, it feels like. It's just not. And so that's where my question was, like, at what point does the cord get cut? Because while there's a CEO, he also has the owners working, and they ultimately will decide if he gets to remain the CEO or not there, you know? So it's their money.
Yeah.
You know?
So this comes back to some of what we were talking about last class, where basically you've got a capital budgeting problem here. They built out this software with an assumption, or what should have been an assumption, that looks something like this. Essentially that, hey, we're going to build out this project, or we're going to build out this software, and it's going to have certain cash flows and expectations for those cash flows that are driven, that have an appropriate risk profile attached to it in terms of discount rate. And then our job as managers then is to measure performance against expectation.
Yeah.
And be able to go, okay, are we meeting expectations or not? And if we're not meeting expectations, why? And so you've got an operational analysis, which goes back to some of the ratio analysis, which can be done at the project level, and go, okay, is it a customer acquisition problem? Is it a product problem because it's not selling? Is it a customer problem because it's selling but they're not paying? Is it, so you kind of begin to peel back the onion and try and understand the failure. Is it because we're not promoting a good product? But at some point, you also need to analyze. In finance, we don't care what's happened. We only care what's going to happen.
Right.
And so you've got to start looking forward, or you've got to be looking forward and go, well, we may have spent $5 million developing, task software v3.0. And if it still ain't selling, we've got to look forward and go, okay, what do we need to do? How much do we need to invest to get v3.1 or v4.0? And what's the potential cash flows? And what's the real risk profile? Because that discount rate may have gone up quite a bit. Now that we're getting less traction than we initially anticipated, we discount it back. And it may make, at this point, we may go, hey, it's going to cost us $5 million to build version 4.0 because we missed with 3.0 again. And the expected future cash flows on this, based upon the market analysis, is such that when I discount it at 25% rate of return, which is what's appropriate discount rate given the risk associated with the project, the net present value is negative, and we need to just kill this thing off now. That's the analysis that your firm should be going through with respect to the software. And it's hard when it's
blinded, though.
Right. It's hard when it's the baby, right? Yeah. Because you're like, well, my baby's really pretty, and no one calls my baby ugly. Yeah. And part of the benefit of finance is it tries to take some of that subjectivity out, and you go, it's like putting the baby in a beauty contest. Other people are calling the baby ugly too. And the analysis, you tell me, and I've been in this situation where the product is bad. And you do this analysis, and I've sat down with the product owner and said, explain to me where my assumptions are wrong. Not that your product sucks, right, which might be very true, but here's how I came up with my assumptions to build out this. Explain to me, based upon these assumptions that I used to build this for cash flow stream and discount rate, why am I off? So you take the conversation and you spin it back to, no, explain to me why your baby's not ugly.
Right.
And explain to me that the warts are really a feature, not a bug. And explain to me that, the fact that the baby has no hair and is 4 years old is a feature, not a bug. And explain to me why no one buys the thing is a feature, not a bug. And what am I missing? And you begin to try and get the person to defend the position based upon facts and data and analysis, and try and create from the subjective, try and create an objective analysis. Sometimes you're able to get them to go, yeah, the baby might not be as good looking as I thought. Rarely will they say it's ugly, but they might start getting to the point where they're going, yeah, maybe it's not as good looking as I thought, because they can't refute, or even if they do refute and go, oh, then we're going to sell twice as much of that. Okay, so let me plug that in. It really doesn't change the analysis much, or maybe it changes the analysis some, but you go, okay, so what's going to be the point at which we measure success or failure? Because we're saying in year one, in the next 6 months, you're going to have $1 million in sales. If we don't have $1 million in sales, and it takes another year to get there, the net present value falls to negative again. So, what's the risk that that's going to happen? And what you really want to do if you're the finance manager is have that robust discussion around poor products or decision making going forward, and go, we've already sunk costs in this thing. But that doesn't matter. We're really looking at, in finance, we're looking at forward-facing cash flows.
That's a good point. I guess what thinking about it that way, it's not thinking about what's the loss leading up to this, but
Correct.
what we have to gain or lose in the future.
Based upon what you have today. So what's the additional incremental cash flow out and in based upon what we know today, and discount that cash flow stream back, the net out and in, look at it as of today, go, what's the net present value? And go, if the net present value is 0 or greater, proceed. And if it's negative, don't. And at least you're able to, at that point, have a meaningful discussion with some real numbers or real estimates of numbers around whether to proceed or not with the project or with the redevelopment of V 4.0 or what have you. And so that's the challenge, though, is we tend not to, and this is we meaning executive types, tend not to want to go through that exercise because we don't want to know the answer. We want to be able to rely on our instinct. We think we're all Steve Jobs, and if we just put the button here, it's going to sell like hotcakes, and that's most of us aren't.
But if the company's not in, like, we're in a good position, we're still growing, we're still hiring, the other products are doing really well, is it fine to have this product struggling, especially if the owner does love it like a baby?
Nope. Not from a finance perspective.
Right.
You'd be looking at what's the expected future cash flow, and does it make sense to continue or not based upon now. You have the ability, you have capital.
Right.
So you're going, okay, I've got capital, but your decision should be, should I proceed with this? What's the best use of that capital? So now, again, we're in a capital budgeting decision and a capital structuring decision. So you're going, okay, I've got $1 million of profit coming in off of our existing business lines and they're doing well. What should I do with that $1 million of profit? Should I reinvest it in the existing business line? Should I invest it in this new business line? Or should I pay it out as dividends? What's going to optimize the value of the firm? And you should analyze each one of those three decisions in light of the tools that we've learned in finance. What's going to optimize the stock price? Well, it's going to be the expected future value, which is going to provide the highest expected future value cash flow. If it's the new product line, and that's going to result in a higher modified internal rate of return than the investment in the existing product line, or then paying it out in terms of a dividend, then you go with the new product line. Otherwise, you pick which one's going to result in a higher stock price based upon the expected future cash flow and the dividend growth rate, or the dividend discount model and the growth rate, and you go, okay, well, I'm going to invest there. So in all reality, you should be sitting there going, yeah, we've got capital and this is good, and these other product lines are doing really well. Should I be doubling down on those new product lines? Should I be taking that money and reinvesting in a new version of my existing product lines because, they're going to be going bad and I'm going to be fighting competition? And so, what's my cash flow stream look like down the road? Once I get to, full penetration and I've got 50 states and I've got all the U.S. territories, should I be investing in a new product line that looks like, task management software? Or is there a complementary product line that I can sell to my existing customer base that will assist? You've got a product that does stuff for the blind. Now I want something that does stuff for the deaf or for the mobility impaired. And so I'm going to do an extension to the existing product line, sell into the same customer base. Or maybe this new software that they're trying to develop, their thought was it's going into the new customer base or the existing customer base. So we're trying to cross sell. And so, what are we missing? Should I invest in additional market research? So, but you should be looking at all those, basically at those three decisions, simplified, dividended out, new product, reinvest in old products, and go, okay, which one's going to be the highest rate of return? And then use the capital for that. It all comes back to finance.
I think if we had, at the company I work for, a more realistic approach to looking at it, it would be going away now. You know what I mean?
Well, it sounds like it's been a multi-year run of development that hasn't quite hit it off with the target market.
Agreed, and I just don't think people know about it. I don't think they've had enough money to just go at marketing or sales. We don't have a sales team for the product. It's purely come to our website, find us, and we tried to work through a partner affiliate channel of consultants who work with small to large size companies and have them integrate the software like we've integrated it internally in ours. But people don't want that. Like people, they just don't have the time, they don't have the energy, they don't have the people to like, oh, let's learn how to write an objective for they want to keep doing what they've been doing unless something's wrong,
Yeah, I know we're a little afield, but I keep bringing it back to finance.
Yeah.
But what I found is I've been in small, mid-sized business most of my career. What I've tended to find has been most successful is a pivot on an existing theme to an existing customer base, or a pivot of an existing product to a new customer base. So it's taking, for instance, your existing case management product and going, okay, what other verticals can we put this in besides state workers' compensation or state L&I or what have you? Okay, well, it might be able to be used at the counties, or it might be able to be used in workplace injury, or it might be able to be used at insurance companies, so I take the same product, make minor modifications to the product, and I pivot into a parallel market. Or I go, okay, I'm already in 40 of the 50 states, and I've got a case management software, and I'm talking to these customers every day, and I'm trying to figure out what their pain point is, because I've already got a well-established high trust relationship with those customers. What's a pain point that I can potentially fulfill given our core competencies? And then I'm selling into my existing channel another product. And where companies tend to, small, mid-sized businesses in particular, where we tend to take high risk, low reward decisions, are I'm putting a new product into a new channel. And you're like, I don't have any core competency in the new product. I don't have any core competency in this channel. I'm not really able to leverage anything, but I'm going to do that because I think the world needs X.
Yeah, that's how it is kind of come. Like, why isn't everyone else doing this?
Anytime someone tells me, well, no one else is doing it, I'm like, there's got to be a reason. And I've gotten that so many times in my 25-year career is, well, no one else is doing it. I'm like, well, then there's a reason why. Now, I realize that that's a somewhat flip answer, because you could have, someone had to invent the radio, someone had to invent the iPod, someone had to invent the personal computer, and I get that. But in general, I look at each one of those things, if you take a step back, as being an evolution off of an existing technology base, or an answer to a customer need that was evolving over time. And most of the time we just miss signals. In this particular case, a lot of companies, particularly software companies, they tend to have if they've had some success, they tend to have big egos, and they all think that they can be Bill Gates or Steve Jobs or what have you. I came out of fintech, and my experience was take a pivot one direction or the other. Same products down a new channel, or new products down the same channel, but don't try and change channel and product at the same time, unless you've got a lot of money, and even then the risk is going to be high. And so so if you were saying, hey, this task management software bolts into the case management software and is really targeted toward our existing caseworkers at the state to assist them with managing their caseload, and it adds kind of a whole other layer of hoo-ah to their existing process, then you probably stand a fighting chance of being able to get some traction. But if you're going, no, it's designed so that Jimmy's sandwich shop can determine what their strategic planning is going to look like for the next 5 years, and you're like, okay, you guys aren't a strategic planning place, you don't know sandwiches, but you think you've got this completely unscrewed. That's awesome. But you're trying to sell a whole new vertical and a whole new set of software that you really don't have a reputation in either, and it's going to be very difficult to get traction, especially without deep pockets for marketing and sales. Yeah. You need deep pockets for marketing and sales.
Yeah.
And technologists generally, I will put myself in that same boat. Technologists generally, we tend to get pretty ginned up when it comes to our product. and a lot less ginned up when it comes to actually the marketing and sale of the product, because we think that it's so nifty it should sell itself, and it doesn't. You need to, as you noted, you need to generate demand. Demand just doesn't kind of show up on its own.
Right, unless there's like a national crisis or something like that.
Even then, it doesn't show up on its own. You've got to be in the right place at the right time for that. What other questions? This will turn into an early night. Let me walk through trying to think where I want to kind of dive in here a little bit. Where do you guys have interest? What's giving you fits? Yeah, so you're going through these chapter after chapter after chapter, and this is a little bit of a fire hose course. And you've got, you've now should have through today at least read through chapters 10, 11, if not 12 through 13, 14. And we're getting close to the end of, strangely, bizarrely, toward the end of the semester or the end of the quarter. Again, midterm next week, and then we've got 2 classes and a final. So as you're looking at this stuff, I mean, I can lecture for another hour and a half. We'll take a break at 6:30. But what areas, I mean, we've been kind of talking about capital budgeting and tying in that to finance and the real world. We've been talking a little bit about overtime and how that might factor into capital decisions and financing decisions. What areas are you like, look, I've been kind of thinking about this and I'm looking at this stuff, because if it's not like show me how to calculate weighted average cost of capital or show me how to spit an NPV out, what areas as you're going through this are you going, hey, this, I'd like to know more about X, and throw any X out there?
So with the shift in the government over the past year, the companies got more tax rates, and then I know my company personally gave it back to their employees. If there's another shift back where we came from, how would that affect us moving forward?
Good question. So tax breaks tend to corporate, so kind of provide a little bit of context, and I will try and keep all my politics out of it, which sometimes is hard. The U.S. going into the current set of, on the corporate side, so I'm going to focus on corporate tax policy. The U.S. had some of the highest marginal corporate tax rates in the world prior to the new tax law. And so what ended up happening was companies structured their ownership as well as their cash flows to keep assets offshore. So you had, for instance, Microsoft would say, okay, we're going to have a company in Luxembourg or Ireland. We'll sell all of Microsoft's software to everywhere but the US. And then they'll collect all the revenue from it. And then they'll pay Microsoft corporate a fee for software development. And they'll keep most of the money offshore in Luxembourg, and they'll pay 14% or 18% or 22% taxes, and they'll reinvest that in European or other offshore business operations. And then here in the US, where there was a 35% tax rate, they would basically take as many expenses as they could here and have as little revenue as they could here to minimize their tax rates. And what you heard, or what you can look at as you kind of go out there and search the interwebs, is this thing called tax inversions, where companies would move themselves offshore to reduce their tax rate. And I'm giving some background because it'll get to your question and specifically your company. By dropping the tax rate, the corporate tax rate, to 21%, which is more in line with even countries like Denmark and Sweden, it provides an incentive for reinvestment in the U.S. So companies are far more likely to bring back money that was sitting out overseas and reinvest it in the U.S. now that the tax rates are a little bit lower here. Additionally, what some companies have said is, look, if I originally was going to make $100 and I had to put $60, $60 went in my pocket or was reinvested, and $40 went to the government in form of taxes, and now it's going to be $21 to go in the form of taxes this year, and it'll probably be this year only. I'm going to share some of that with my employees. I'm going to kick them $10. I'm going to keep $10, put it in my pocket. The federal government's going to get 20, and everybody's happy. Except the federal government, because they used to get 40, now they're getting 20. But my employees, I shared some of it with the employees, and I put some in my pocket, and everything's good. And some of that is a publicity stunt on the part of companies, kind of going, here's $1,000. Yeah, we're going to take advantage of this to kind of hand out some money. In so doing, particularly as it pertains to the foreign tax inversions and the foreign tax structuring, by dropping the existing tax rate, corporate tax rate, from 35% to 21%, it makes it, and having no expiration on it. So on your personal taxes, in 10 years, they go back up. 2022, so actually not even 10 years, 5 years, they go back up. Corporate taxes have a permanent reduction. The reason they did that, Maria, was to make it difficult for somebody in the future to make a change and come back and go, okay, we're going to raise taxes by 50%. Because corporations will scream, it's going to slow down businesses. They're going to say, oh, we've got to pay from our workers. We're going to have to lay people off. We're going to have to. So the structure of it was such that it's causing a fundamental shift in how companies do business. It will for at least the next 3 to 4 years. I mean, even if you see a change in Congress in 2 years or in 2018, next fall, you're still not likely to see a major shift in tax policy because the president has a veto until 2020. And then 2020 would be the next presidential election. And assuming that the current president doesn't win re-election, which I don't think is a far-fetched assumption, and you've got a Democratic Congress, it'll be 2021 or 2022 before they put another tax bill forward. And they're not likely to make major changes because those major changes are going to be painful they're going to be like, no, we can't do that. It was from the structuring perspective, it's made it very difficult to go backwards. In the event that they do go backwards, what's likely to happen is companies who have been investing domestically are likely to do like they did in the 90s and shift more of that investment overseas. It's going to cost some jobs domestically, but the companies are looking at it from a finance perspective going, okay, how do I optimize value? And right now, the optimization of value is there's a tax holiday to bring money back, and there's an advantage to investing here in the U.S. So they're going, because it's cheaper to manage in one country than it is in two. So they're bringing money back in, and they're investing in folks and handing $500 bonuses to workers. 5 years from now, if that shifts, what you're likely to see is a little bit of a reversal of that. So jobs are going to likely be impacted domestically, and foreign investment activity will pick up. However, I don't think that you're going to see a major shift in tax policy, at least at the corporate level, in 5 years, because it's likely to be extremely unpopular. Having said all that, the current tax policy, the president's tax policy, along with the deficit spending, along with the infrastructure bill that he's proposed, are extremely stimulative to the economy. at a time when the economy is already stimulated. So, because there's already, in a lot of fields, there's worker shortages, real wages are starting to rise, inflation's starting to rise. The Fed is looking at raising interest rates to try and kind of pull the economy down a little bit. And we're pouring fiscal stimulus into the economy in terms of government spending, government deficit spending. So the twisted part of me says we're headed to a recession.
Right.
And it's likely
inflation too fast, right?
Right. Essentially that we're overheating the economy too quickly.
Yeah.
And there's not enough and it's being overinflated by government spending and tax policy, which will then require more money to be borrowed for federal government debt, which will drive interest rates up, which will drive, and inflation will go up, which will then cause the economy to slow down, and it'll end up causing a recession right about the 2020 election. That's my prediction. And so at that point,
not a major recession.
Oh, I think it could be. No, I think it could be ugly.
Really?
Yeah, I think it could be ugly. This
not like 2008 ugly, or
like no, I think it could be 2008 ugly.
Really?
Yeah.
And
We've seen an expansion for 10 years.
Yeah.
At that point, it would be 12 years. That would be one of the largest post-war expansions in history. That would be the largest post-war expansion in history. I think we're already there. And so the longer it goes and the hotter it gets, the harder the fall. Yeah. And so I think you've got something coming. And as a result, what we should be looking for, and there's a chart here. I had it in my last class, my class today. So when you look at interest rates over time, and you see a recession, and then this recession, you're looking at, in each one of these cases, you see prices come down dramatically because of the recession. Demand starts to fall, interest rates fall, but of course, we've kept interest rates low. One of the ways to get yourself out of a recession is monetary policy, essentially going, okay, I'm going to drop interest rates to stimulate borrowing to drive demand up. That's classic Keynesian economics. We can't drop interest rates lower than zero. And so they've essentially stayed down here at zero. They're starting to tick up just a little bit, but they've been down here at zero for a long time. So if the economy hits the skids, we've already hit all the fiscal stimulus buttons with the tax cuts, with the increased military spending, and with the infrastructure spending. And the interest rates, short-term interest rates, the Fed said we're going to raise them 4 times this year, potentially. They might only be up here. And so you go, okay, we're going to drop them back down to zero. Well, you've already kind of pulled every lever to keep the economy overheated out to 2020. I mean, this would be 2009 to 2020 is an 11-year expansion. The longest you're going to see on here, you have 2001 to 2008, 7 years. You have 1991 to 2000, 9 years. We're going to be, really pushing 12 years, 13-year expansion, and it's going to have been fueled by extraordinarily, historically low interest rates, both at the long term and at the short term. And so I think it could be really bad because you don't have a lot of tools in the toolbox you can still pull out and use to bludgeon the recession. You're going to be kind of stuck having to ride through it. It's going to correct, not only it's going to correct a lot of this. Really, these interest rates should have been ticking up over time as the expansion occurred here in these periods, and they didn't.
So the government can't just to avoid that?
Well, they can. The Federal Reserve is responsible for analyzing interest rates and trying to keep inflation. What they've been doing is trying to keep an inflation target of around 2 to 3%. Okay. So inflation's been in target. So they said, okay, we're not raising interest rates.
Because back here, you see when interest rates went up, it was because inflation started ticking up over this magic 2.5% to 3% range. So the federal government said, okay, or the Federal Reserve said, okay, we're going to slow down the economy by raising rates. Well, it worked. Bang. You know, this is the 2008 recession, but they had caused a pretty significant increase in interest rates. So I think, absent any significant changes to monetary and fiscal policy of what we're seeing today, when you do have that inevitable recession, there's not a lot of leverage the government can pull. They're talking about raising short-term rates, so getting back up into this 2% range out here. But when you look historically, that's still historically low. You can only drop, well, in theory, you can only drop interest rates to zero. In practice, some European countries have negative interest rates. Essentially, they pay you to borrow money in the short term, and the banking on it. You guys had to take the JBLM, right, when you banking?
That's the spring of 2 months.
Oh, is it?
Yeah.
I haven't taken it yet. It's on my plate.
Okay, because I was about to say, I know they've
I
changed.
think this is now the prereq for that class.
Yeah.
Yeah.
And they've changed the requirements so that after, I think, this year, the JBLM will no longer be required.
So why do I have to take it? That's the class that she told me like a week ago I have to take.
Everything. And probably the reason why she didn't know you had to take it was because she didn't know when it fell off as required for graduation. But it's actually a lot of it is this. You're basically going through this type of financial discussion and talking about how the banking system and the macroeconomy interact with the firm. And so I taught it last year. While teaching it.
It seems really interesting.
Yeah,
I'm not like against taking it. But
yeah, no, and the way I teach it, I'm not sure who you're going to have.
I have Riley more.
Riley's really good.
Yeah.
I've
had it for economic class.
Okay, yeah, Riley's really good. So you'll enjoy the class, I think. But the way I teach it is very much okay, let's take an issue and let's talk about it for the class. You know, let's kind of deconstruct it and talk the economics. What's the pros and cons of what you see. So the discussion we just had for 10 minutes or 15 minutes is what, you know, in my class would be a 3-hour discussion
Right.
or a Tuesday or whatever on interest rate policy, fiscal policy. What other questions?
Well, hold on just a little bit longer, I guess. If there is a recession, then it's going to last longer than the last one because of the interest rate being low, right?
Potentially could be longer or more severe or both. You know, normally the theory is that a recession is because the economy's gotten out of equilibrium. And so it's kind of forcing itself back into an equilibrium, pricing a supply and demand equilibrium. And so recessions essentially, depending on whether you're a Keynesian or not, is a lack of demand. So you're saying, okay, the demand has dropped, so we need to stimulate demand. And depending on how far demand is dropping, based on pricing and other things, will determine how severe the recession is. Generally, the rule of thumb is the longer and stronger the growth, the more severe the recession. But that doesn't necessarily mean it's longer. That may mean that it's a very short but very painful correction. And, you know, like this 2001, which I remember well, was a very short recession. It was pretty painful. We had all the dot-coms blow up. We had Enron blow up. Enron was my biggest customer. So Enron blow up was not fun for the company I worked for. So this was a very short, a very painful recession. 2008 was both deep and long. It was a very painful recession because it tended to hit consumers harder. Where 01 was largely a business recession. 2008 tended to be more of a consumer-based recession because consumers had built a lot of their wealth around real estate. When the real estate market crashed, a lot of that wealth went with it, or they had loans sitting on top of houses that they were like, okay, I'm down underwater, screw it, take my house. I'm never going to get out from under this thing anyway. I borrowed more than I can afford to pay. With the anticipation I was going to flip the house and be able to pay stuff off. And so then the consumer ended up with consumer bankruptcies of record high. You ended up with houses on the market that couldn't be sold. You had banks that had loans that they sell the house for $200,000, but they wrote $350,000 on the home, so they wrote off $150,000 on the mortgage. The company, as a private equity firm at the time, they sent me into accredited home lenders in San Diego, California, which was not a bad gig. San Diego's not a bad place, but the job was not a good job. The company was a company that they had Eames mortgage, which was around here, and you walk in and sign up your home loan and your loan money. And when we got there, not only did we have a bunch of places immediately closed down, residential or retail mortgage locations and wholesale processing operations, but when we started looking at the mortgages that they wrote, we say, oh, it's a 4-bedroom house, and this was like an OBS. There was a packet that I looked at, and I'm like, you gotta see this. 4-bedroom house with a pool, and we borrowed, and it was in California, and we planned $435,000 on it. And so when you look at the appraisal, you're like, okay, you look at the top level of the appraisal, you're like, okay, that's fine, no pictures, but you're looking at the thing, that's what I'm looking at. When our guy went out to the house, because we had foreclosed on the house, and then went to go to the foreclosure sale, it was literally a freaking shed that was sitting over a pool, an in-ground pool that had the water in it, and had
power. 4 bedrooms? How'd they get the 4 bedrooms? That's where I'm confused.
Oh yeah, there was no 4 bedrooms.
Yeah.
It was basically a little pool house and a pool and a shed over the pool. So you had a bathroom and you had a room on the pool house, and then you had this shed thing over the pool, like an indoor pool type thing. So it was like shed is probably a stretch. So you see enclosed pools out there, pool enclosures. It was basically one of those with an in-ground pool, no water in the pool. The power was running out from a stand pole, so essentially it was extension cord out to the pool house. And they wrote that up as a 4-bedroom house. It was a little pool cabana and this pool shelter. And it was probably worth $125,000. We loaned $400,000 and some thousand, foreclosed on it, sold it for $78,000 because you are selling it in a bad market. The mortgage company I was working for, or I was a CFO for at the time, lost $400,000 on that.
So if I was looking to buy in the next 2 years a home, I should wait until this apparent recession comes? Well, I guess this one was more directed at the housing market.
Yeah, and I thought, it depends. Are you looking to buy?
We'll probably move in the next 2 years, so I don't know.
Well, I wouldn't buy now.
Right, yeah, that's why I'm looking 2 years or more.
Yeah. But it's one of those things where don't buy a house because you think it's a good investment. Buy a house because you think it's a good house. And you're like, yeah, I can afford this.
And my parents are like, you need to buy a house because they're like 70 years old and that's how they think. But I'm like, no, it's in this area especially, it's like better to rent, especially if I'm looking to be here for another year or 2 years.
That is absolutely true. What I've told folks is I said, look, if you find a house and you go, I want to live here for the next 5 to 10 years, and I don't think I'm going to be moving, and I'm not looking at this as an investment. I'm really looking at it as it's a stable place for me to raise a family, to be able to for me to do whatever. I love the house, and I really like what I'm doing, and buy the house. If you're expecting the value to go up, and you're not going to make money on a house, it's not the right reason to buy a residence. Might be the right reason to buy an investment property, it's not the right reason to buy a residence.
Right.
If you're going to live in a house, buy a house you like, plan on living there a while. If you make money on it, great. If you don't make money on it, that's fine. And if you look at it and go, hey, the price of living here is the same as what it would cost me to rent after taxes, which, by the way, the tax proposition on owning a home changed dramatically in the last 6 weeks or 8 weeks, then go ahead and buy it. And if it doesn't, and you're going, screw it, I'm not in love with the place, I don't really want to have a house, I don't want the headaches of the house, but everybody's pressuring me into it, it's like make money on a house, that's not the right reason. If you want to do that, go buy rental property, it's all paid rent, and then you go rent from someone else. the house as an investment thing is a kind of a bad thought process.
I mean, maybe in the 50s it was a good thought process.
It wasn't even then.
Yeah.
I mean, the thought process of I'm investing in a house, it's really now, if I really like this house, here's what happens. Over time, you see the pink bars, you have inflation.
Mm-hmm.
So over time, rent goes up.
Right.
Rent goes up faster than your mortgage payment will go up. Over time, your mortgage payment goes up because your property taxes go up and your homeowner's insurance goes up. But in general, it goes up slower because the bulk of your payment is principal and interest.
Mm-hmm.
And that, in most cases, is fixed.
Mm-hmm.
So over time, as your rent's going up 2, 3, 4, 5% a year, your homeowner's payment is going up maybe 1% a year or less because it's only the property taxes and insurance that go up every year. So after 5 years, if you were paying $2,000 on the house and $1,800 to rent, after 5 years, you might be paying $2,100 on the house, and you're paying $2,400 to rent. Over 10 years, it starts to flip. But the issue isn't, yes, you can sell a house for more, but that's not the goal. Because if you sell a house for more, you then have to go buy another house. You got to go live somewhere.
Yeah.
So it's really, I like the house. I think I want to stay here. I'm going to stay here for a reasonably decent period of time, a minimum of 3 to 4 years. And over that 3 to 4 year period, my housing payment is likely to go up by 1 to 1.5%, maybe 2% a year. My rent payment is likely to go by 4 or 5% a year. And so at some point on a capital budgeting model, the two of those things are going to cross. And it's normally the 3, 4, 5 year point, depending on what current interest rates and rent increases are. And at that point, you're like, okay, it was long term, it's better to stay in this house, but it's only better to stay in that house because you're sitting in it. And you're going, okay, the rise of the cost is going up slower. If I look at my house now, I bought my house in 2000, up in Bothell. And so my mortgage, including property taxes and insurance, is $2,000 a month. It's a 3,000 square foot 5-bedroom house. Now I can't rent that for $2,000 a month, but I've also been sitting in it for 17, 18 years. And so, the other side of it is the only reason it's $2,000 a month is because I've sat in it for 18 years. If I was flipping the house every couple of years, I might have gone from whatever I paid for it to $350,000 or $400,000 when I bought another house. My payments would continue to go up as I flip the house. And I'd go, oh, I've made money. Not really. It's all about cash flow, right? And so I'm sitting here going, the amount I'm paying to live in this 5-bedroom house is the same as the folks around the corner on Bothell Highway are paying to live in their 2-bedroom apartments. But that's only because I sat in the same damn house for 18 years. And so, folks like your grandparents, it's not that in the 50s it was a better buy, or for me in 2000, right here, going into the recession, it was a better buy. I bought it right at the peak in 2000, and then wrote it down, and then back up, and then wrote it down again, and now back up. It's because at the end of the day, my payment would stay flat, and if I was running it down up, that 4 or 5 year point it would cross. Well, what pressure do you buy a house?
I'm not quite sure. I just I don't have the time to take care of my house right now. I'd rather just rent a cheap apartment.
I make mistakes like anybody else, and I don't feel bad about making mistakes unless I make them more than once a whole lot. And then it is a problem, right? But so it's not like that in this situation. But I've always thought the opposite of what you're saying, and I didn't. So like in this class, I couldn't put it together because it's a cash flow thing, and it depends on how you look at it. It depends what you leave out, because I can explain it my way without talking about, like you're saying, if you flip a house, you're still paying more and more and more every time you buy a house because your payment's going to go up. So my mortgage was $1,100 a month for 12 years. It did go up a little bit. It was like $900 anyways. So then now my mortgage is $1,700 a month. But I have the house that we fit in now.
Yep.
It's a better house,
But you said the first house for 12 years, right?
Right. And then I hit it every year I was there. Because after about the first 2 or 3 years, because it was so small.
Right.
And so we got a bigger house, of course, bigger payment. But I think I might just end up staying in this house for a while. Just staying for a while.
Well, that would be that's the logic, is you go, okay, I've outgrown house X, or I've outgrown apartment X, now I'm gonna live in other living arrangements.
Yeah.
You find someplace like the one you just found, where you go, hey, I'm planning on staying here 5 years. It probably makes sense to buy. And if you're going, no, I'm likely to want to get out of here in 2 years, I'm gonna need something bigger, and I want to downsize, or I'm gonna want to move from Puality, Elm, or whatever, then you go, okay, it doesn't make sense to buy, it makes sense to rent. Once you figure in your transaction cost being the end, you know, it's closing costs and plates and now with the taxes, you no longer have a tax shield, essentially, on your mortgage. So property taxes are no longer deductible under the new tax law. Mortgage interest is deductible, but only if you spend and exceed your standard deduction, and the standard deduction is double. So most of us, I won't end up itemizing taxes.
All right. I did my taxes, you're like, double, it moved 12 to 24, right?
Right.
24,000.
Yeah.
That's crazy.
Yeah, so you're gonna go, everybody used to go, oh, you buy a house, you save on your taxes. You're like, no, not anymore. For most of us, we're buying a house doesn't save crap on our taxes. If you rent, you get the same deduction as a homeowner. The new tax law was extremely beneficial to renters. It does not provide, it took away a lot of the incentive for home ownership by eliminating the state local tax deduction, the SALT deduction is earlier called, state and local taxes SALT. And it took away effectively took away the mortgage interest deduction by raising the standard of deduction so high that most people don't have a big enough mortgage to qualify to itemize. So a lot of the rationale that folks use to justify buying a home, like to write off the property taxes, you can write off your mortgage interest, and you can't write off anything if you rent. That was all just thrown out the window by the president about 30 days ago, 25 days ago. All right, let's take a break. Let's take 10 minutes. And we'll reconvene and see if there's anything more to discuss. I want to make sure you guys are getting your money's worth out of it.
I feel pretty comfortable with the material right now. I mean, I'm sure I'm gonna have.
It's hard, it's not hard. The hardest part is the volume of it.
Yeah, agreed.
Not the math of it. I gotta find it. Ah.
Oh, I was like, I know they've got to have something in here because I'm not the first one that had this problem.
You know, I busted my butt to go to school, trying to find time to go to school, and I have to work because I live in a two-income family. It won't work without that because we have 3 children. And of course, I paid up a lot of debt when I sold my house to anticipate the higher mortgage payment. So things just pretty much evened out for me. I had to pay all the money for the mortgage instead of to other credit card or whatever. But I'm trying to. I want to open up a business, but I'm such an analytical deep thinker that I talk myself out. I talk myself into something, and now that every time because like my father-in-law, he's a genius when it comes to cars. He's been doing it since he's been 16 years old. He's 50. He's almost 60 years old now. He can climb up and climb anything about it. I was thinking about getting together with him on automotive repair shop, but those are in after I don't know how long an automotive repair is going to last, and I want to get in real estate for such a long time. I even took some classes when I was employed in marketing and real estate sales, and inspection reports, stuff like that. And then, I don't know, it's such a hard thing. It's such a hard decision to make because I can get another loan, I can get a small business loan. If they give me one, I'll venture. As long as I have a good business plan set up, and so this isn't gonna be that hard, but I just can't decide on what I want to do. I can do so many different things, I just can't do anything really, really well. And it's such a hard thing, and I'm gonna graduate probably looking at like June next year, maybe mid next year I'm gonna graduate, and I would like to start up something then, but the risk is so tough because I'm 40. The risk is such a tough thing to swallow. You know what I mean? If I'm tired of working for people, I'm trying to work for people, and I see all these things, and I put the pieces together, and I see the leadership and how they mess things up. Like my company I work for, it's a good company. I mean, it's overall it's a good company. Like I like what she's talking about her company. They're trying to help people. And I've been working trying to help people my whole life. I mean, started with the Army, and I worked for workforce, getting people jobs, and all that stuff. And now, I work in the human research industry. But it's a private company, and so there's no security there. One day, the people showed up, and they was told to follow, their supervisor to the room. Somebody came behind them, threw the desk out, and people just seen it, and it's just, that's how one person was there for 11 years. She was it's such a drag, and I just don't want to put myself in a situation to do it longer. But then, and I want to work for myself, but it's a hard thing.
Well, the biggest thing that I homeland business, and before I made the mistake, was a spreadsheet for the savings for the business rather than you got to have a passion for business because it's going to consume your life. As a business owner, your life becomes a business.
I spoke to my wife about that already. She's not happy about it, but it will be the same amount of time that I'm working right now. So it wouldn't be no different except for the fact that I would be content as well as before that.
Right.
And I'm not right now.
But are you choosing what the business is, trying to have a passion about the business, as well as a passion about the business. So if you're going, hey, I've got an interest in, you've got a personal interest in.
I'm interested in automotive repair. It's like a puzzle, and it's there's not as much, there's a lot of things to it. I mean, it's really interesting. Work on my cars. I've always had a spare vehicle that I would tinker with, and I would replace things with it. I look up a YouTube video, and I get it, and I go fix it. But I just don't see a future. I don't believe there's a future. So it's tough.
That's changed a lot since I've got 74.
Oh yeah,
that's easy to work out.
Mm-hmm.
New cars, not so much.
No.
Like I got plugged into the caliber.
Yeah. What to do? What to do? Where's everybody at tonight?
I have no idea. You were like 5 minutes late, and I was here like 5 minutes early, and I was like, did I miss something?
We usually here early, a little bit early, but
Yeah.
I got to work a little longer, and I got to work a little bit more.
Traffic's always a factor.
Yeah, this morning I left from my house to go work 5 minutes later than I usually do, and I got to work 20 minutes later than I usually do.
Oh, really? 5 minutes does make a difference.
Because of, time frame in the morning.
Yeah. Yeah. Yeah, the train accident that happened
Oh, yeah.
ruined my life. not literally, but I live in like Hotchkiss area and I work in Buchanan.
Okay.
And so I like missed the train by like 15 minutes, which is fine. I was going north anyways. And it kind of crossed down south. And then, but I didn't know it had happened. And I had a final that day.
Oh.
So I was in like my morning meeting and my boss was like, oh, did you hear about the train? I was like, no, what are you talking about? He's like, yeah, train fell on I-5 going southbound. And I was like, oh, I gotta go then because I have a final in an hour and a half.
Yeah.
So I was an hour late to my final, but my professor. Did you finally just like watching?
Oh, I was sick as a dog the end of last week.
Oh, no.
And so it was one of those things where I slept a lot this weekend. Didn't do much.
Just a head cold or?
Sinuses.
Oh,
So I will survive.
so no fun not breathing in the meantime.
No.
Yeah.
And I was running a fever for a couple of days, and we had board of trustees meetings, so I got to hang out with your uncle among others,
Yeah.
and so that tends to be a very busy, high kind of
Right, and we have everything just like
you're
chilling
running,
out up here.
and I'm making presentation after presentation after presentation. I had 5 presentations to make over the course of Wednesday through Friday. It was by Friday afternoon, I was fairly well wiped out.
Yeah, you're like, I gotta go.
Yeah, and then I live in Bothell, so I drive from Lacey to
No,
Bothell.
you do not.
I do.
Every day?
I live in Spangler Hall during the week.
No, you don't.
I do.
This is crazy.
I live in Spangler,
Oh my god.
and then my house is in Bothell. I go home on the weekends.
Wow.
I leave Friday afternoon and come back Sunday night or Monday morning, and then live in Spangler for the rest of the week.
Crazy.
Which makes it, kind of, in one sense, the commute would be so brutal that there's no way I could do it.
No one can handle that. That's a lot.
Like,
Impossible to hear. No way.
but the Spangler thing is, that's kind of, in one way, that's kind of neat because I just kind of roll out of bed, I throw on clothes, I get a shower, throw on clothes, I walk up the hill, go to my office, walk back down, I eat in the cafeteria. I'm like, oh, that's not bad. You do get a little stir crazy being on campus all the time, but it's. Have you ever lived on campus at all?
No.
Okay, it's actually.
I'm in the dorms. I just haven't lived on campus.
Okay, yeah, it's a good quiet. I mean, it's a quiet campus to live on, and it's a wonderful place. I mean, the campus is
so many trees.
beautiful, and so and I like to walk a little bit. So you got the deer out all over the place, and it's one of those. You got monks walking around. I mean, it's kind of cool, and so I'm like, oh, this is, and it's still 2 years of this, and I'm like, oh, I still dig living on campus during the week, but I do like to leave on the weekend. Go to my house and actually like have a house and sit down and relax and spend time with my kids, and so it's that's a plus. But yeah, I don't mind the.
You haven't thought about like moving down here because your kids are up there. You don't want to like just schooling.
Yeah, and they're very entrenched up there.
Yeah, I get it.
And so it's and my jobs have always been prior to this have had a lot of travel. So I commuted to Wichita, Kansas for a while. I commuted to Southern California. I commuted to Plano, Texas. And so it's just one of those things where you're like, okay, you do what you got to do. And this is easier in that like tonight, if I wanted to go home, I could leave out of here and I'd be home by 9 o'clock. And then the biggest pain in the neck is getting up at 5:30 in the morning to beat Bellevue traffic. Because Bothell to Bellevue takes an hour. And then Bellevue to Lacey takes an hour. So in the morning, if I can get ahead of Bothell to Bellevue traffic, it's an hour and 15 minutes to campus. It's actually not bad at all. But if I wait until 7 o'clock, it's 2.5 hours.
You could get up really early and beat the traffic and then take a nap, honestly, at Spangler Hall before you go to work. I don't know if you'd want to do that, but.
Not normally, because there's just a ton of miles on my car for no. I'd get up there at 9 o'clock. Kids are going to bed. I'd get up before the kids get up, and I'd load up in the car, and I'd drive all the way back, and so I just burn, 200 miles on the car, and so I could sleep in Bothell. So that's why I felt very fortunate that the university saw fit to.
That is really cool, honestly.
To have housing available.
Hopefully, you made it a little bit healthy.
Oh yeah. I've got pictures and bookcases, and the monks gave me a recliner, and I've got a TV, and I've got a double bed and a big screen TV in the bedroom, and so it's homey enough.
Yeah.
I mean, I'm a dude, so it's there's only so homey as you're gonna get.
Well, and if you were like traveling on the road every week, then that's about as homey as it gets.
It's homier than that.
Yeah.
All right, so what else you guys want to cover?
I guess my only question is the midterm going to be made out of questions that we've already done? Okay.
If you've done 3 or 4 rounds through the other 3, you'll have seen pretty much every question that's going to be on the midterm.
Okay.
It's essentially a recycle of the first 3 quizzes.
Yeah.
And same format, same questions. It'll randomize the question order, and you shouldn't find it to be any more difficult.
So we can exit that quiz like we could exit the.
Yes.
Okay.
Yeah, it's the same. It functions the same way as the quizzes do. So you can exit, come back. You can, it's.
Okay.
If you run into any problems while you're taking it, let me know, and I'll reset you. I mean, that's not. I don't want to be draconian around it. You've got two tries at it, but it is long. So 2 tries is a lot of hours, and I recognize that.
More than 33 questions, I think.
Yes.
Okay.
Yeah. Let me. I can take a quick look and see what it is, just so you're not shocked. I think it's 50. It's either 50 or 66. $50.
Okay. That's not terrible.
Nope.
Yeah, no, I feel pretty good about it. I've done all the quizzes so far, so.
Okay. Anything else? I won't keep you all night.
Oh, is I think the next, since we're not meeting next Monday,
Yes.
the next quiz is due by the following Monday or the following Tuesday?
It's the following Tuesday, I believe. Well, but again, it's easy enough for me to check.
Yeah.
So I think I scheduled them all for Tuesdays, so that way we had Monday to.
Okay, if it is Tuesday, then that's Otherwise, I'll email you my questions about it.
Okay. Yeah, my intention was to have them all do Tuesday, so that way we had Monday to answer any questions. Oh, no. We got it scheduled for Monday. But I'm going to move it. No, it's Tuesday.
Well, that's a procedure.
Yeah, that's hard.
Yeah, that's difficult.
And that's final is on the
So we
5th,
have
right?
2 more sessions in a final. Yeah.
Yep.
Yeah.
And then after the final is a quiz. I'll make the
really?
quiz due, yeah, for the last 2 chapters. The final will be in class.
Oh, so we only have 1 more? No, we have 2 more classes in the final.
You have, well, yeah, let me look.
We have 1 more class in the final.
What?
Wow, we do. Isn't that crazy?
Wait, how many more classes?
1 more class and then the final.
Yeah, because the last day for this semester, I think, is the 10th. For this,
You're right.
so it's you got. I mean, this is going like a freight train. I mean, it's a quick moving
We have 1 more
quarter.
class in the final. Okay. And we have a quiz due. Okay. I wish we had 1 more class. I thought we had 1 more class. Okay. So next class, we are asking you questions for the final.
Yep. So next class is going to be the 26th.
Yeah.
And like any class, you guys can ask me questions about anything within reason, and I'll answer it. But you've got the class on the 26th. You've got the quiz due the day after on chapters 11 through 13. But really what you're going to get the next class on the 26th is I will release to you the information you need for the final. So I will be going through, here's the annual report that you're going to use for the final exam. And then, you know, I'll walk through some of here's some critical pieces that you're probably going to want to figure out where the stuff is. Once we get through that class on the 26th, if I were you, the 2 things that I would do outside of trying to wrap up those 2 quizzes that you see up there are I would put together an Excel spreadsheet kind of pre-populated with a bunch of the ratios from chapter 2, a bunch of the time value of money calculations from chapter 4 and 5, stock price valuation, some of those things. So as you've been putting some of these things together and doing the homeworks, what I've suggested to a couple folks who have come and seen me for my Lacey section is I said, look, just put them in an Excel spreadsheet and put tabs, and then label the tab. You know, this is a stock valuation problem. This is these are some ratios. This is, so that way when you get to the final, you just pull that up and you go, okay, I've already built this thing and I know it works because I did it on the quiz and I knew I got it right. And so then you can just start changing the numbers. And we've shown how I like to build those Excel spreadsheets. And I emailed you guys some videos from last week that essentially showed how I like building them. I mean, it's relatively common structure on how you build your input tables and then let it flow through your formulas. So if you do those between now and then, when you get to the final, there's a lot to cover. I mean, the finals are very comprehensive. It's tough to even finish in the 3 hours. And so if you've got some of these things built, it'll make it that much easier for you to get it done. That's the first thing. The second thing that I would do is I would print the annual report that I give to you. I'm going to give it to you electronically, but I would print it.
Okay.
And I would tab with Post-it notes or whatever the key disclosure things like the income statement, the balance sheet, the statement of cash flows. You know, and we'll talk through some of the critical components again as a refresher on the 26th. But I tab them so that way you're not having to flip through this thing or look for it online. The students who were most successful with the final exam when I gave it in this format spring of last year had both the electronic version of the financial statements in Adobe Acrobat Reader pulled up, as well as hard copy. So that way they could search for keywords, but then once they would find what page it was those keywords were on, they tended to then flip over to the hard copy, make their notes, scribble this stuff, highlight that, pull it over, and then flip over basically to the Excel page on their laptop and do the Excel work. So they used the Adobe piece to find it, then used the hard copy as a reference set next to them, did the Excel piece, and were able to get through it. I had folks in that the final ranged in grades from a 14 to 105. The woman who got 105 did not only all the extra credit questions, and there's a couple of them, but she operated the way I just described. She had the electronic, the hard copy, and then she would find it here. She'd flip it open to that. She'd do the work up here with the Excel spreadsheet up on her screen, and then flip through. I can't tell you who it is, but I'm just telling you, I had somebody who was, well, Jessica works for me now.
Yeah.
In the finance office, but so it wasn't Jessica because she had graduated already.
Okay.
But person I had extremely smart and very good test taker, very a good student, and so that's how she approached it, and it was a successful approach. The folks who tended to do very poorly on that exam were the ones who were like, oh, I don't know where to start, because you get this big pile of papers and you got, and I hand out, here's your questions.
So is it a written exam or is it going to be electronic?
It's a written exam.
Okay.
And what I asked folks to do is I said, look, do your Excel spreadsheet, and at the end of the night, so not at the end of the exam, but at the end of the night, when we're done with the exam, so at the 3-hour point, hand me your test paper with the answers. When you get back to your place, email me by 8 o'clock the next morning your spreadsheet, and that way you get your partial credit off the spreadsheet. What that also does is if you're sitting there going, okay, crap, I realize now as I'm kind of driving away that I probably looked at this question wrong. If you correct it on the spreadsheet and then email it to me by 8 o'clock the next morning, I'm going to use the spreadsheet for the primary grade. If I don't get any show your work stuff on the spreadsheet, and all you do is hand me back and I had someone do that, just hand it back to me, and I didn't know how the hell they got the answers, and most of the answers were wrong, you end up with a 14 on the final exam, which isn't a recipe for a high grade. But I would take the time and try and build those tools before you go into the 5th. What other questions?
Pretty good.
Okay. I feel for the 5 folks who aren't here.
I do too. I don't know why you wouldn't show up. If you could make it.
It depends, but
Well, because I honestly thought we had 2 more classes, and so to see that we just have 1 more class in the picture, I'm sure they're going to feel the same way when they show up 2 weeks from now. They're like, what?
It's
Wait, next class is our final?
Yeah, it's scary, the speed at which this thing's flying.
Yeah.
I want to reinforce, again, the approach that I'm trying to use in here, because we only do have the one face-to-face, is really bring forward questions, and I want to make sure we answer those in here. I don't want to sit here and lecture, and I'm not going to, with just the 2 of you, I'm not going to sit here and lecture until 8 o'clock. I mean, I could, but it's not necessarily the best use of anyone's time. What I do want, however, is if you run into any questions or problems between now and the 5th, or between now and the 10th for that matter, I mean, or even after the class is over, I don't really care. Don't hesitate to drop me an email or say, hey, I just want to sit down with you one-on-one, either after class, if you're not one that likes to ask questions in class, or what have you. And I'm kind of talking to all you people there in the computer, because I'm happy to spend the time. This is I obviously geek out on this finance stuff. I do wish you had the benefit of more classes. I wish you had the benefit, candidly, of the 16-week session down in Lacey. I think it's being able to kind of do this in bite-sized chunks for an hour 3 times a week is a lot easier than 3 hours once a week, in half the time. So if you need anything, let me know. If anything comes up where you've got concerns, let me know. If you're having technical problems, let me know. Otherwise, from my perspective, we're gonna, next week is no class because of President's Day. I'd get the quizzes in as soon as you can. The midterm is a 50 question, take it twice. You only grade the higher of the two, so there's no harm, no foul in giving it 2 shots. And then when we get into the 26th, I'm going to be focusing a lot of the time on the 26th on answering any questions you guys have and doing some prep for the final. And then it's the next Monday is final the entire time with the last quiz. And actually, now that I'm sitting here, I'm going to just stretch that out just a little bit more because that's just cruel to make you go through so we're just going to move that out to Thursday. So you've got essentially the full week. So that way I can also get grades in by Friday. And that'll give you at least a day to recover. My recommendation is I'd knock out, if it was me, and I know I'm not normal, I would knock out the midterm this week. I would at least take the first one between now and Friday, and maybe the second time I'd take it on a weekend. And then next week I would knock out the remaining quizzes because they're small. It's 11 through 16 essentially. And then I would focus on the final for the 26th through the 5th. And when I was done on the 5th, I'd leave here and go to DuPont or little Pints and Quarts or something.
At least for the midterm.
Okay.
Yeah, I feel good for the midterm. I just, being that I had a little time, but I'm not as familiar as I should have, because I like to be on the line of thickness. Actually, I don't know, counting 2 to 1, 101 and 102, I think it was. But the first two classes of counting, and that was more of a fire hose in this class.
Really?
Well, maybe because I have a little bit more of a background now, coming into this class, things are familiar to me. But going into accounting was the hardest ever for me.
Okay.
I had no time to do it, and it was so hard. But
okay, so maybe one of the things I'll try and hit on again, because I know Richard didn't have a lot of accounting coming in either, is I'll take a little bit of time next week when I'm going through the financial statements that we're going to have to use for the final. I'll take a little, or not next week, the week after, I'll take a little bit of time on the 26th to give maybe a little bit more in-depth walkthrough of the various financial statements and disclosures in that annual report, so that, like I said, I know you and Richard haven't had, you've had accounting. He hasn't had accounting yet. So we can take a little bit of time and make sure you're comfortable. And if there's questions on how to read them or where to pull stuff off of, we can get those addressed on the 26th before we dive into the final the next week. The other thing is on the final, obviously you can't work together on the final. You have to work separately. But I'm not gonna not answer questions on the final. So if you have questions like, am I looking at the right thing? Is this the right statement? Don't hesitate to ask. I may say I can't answer it, or you need to have figured that out. But if you've got questions or concerns, don't hesitate to bring them forward. The worst you're going to hear is I can't answer it. Anything else? All right. So if you guys run into anything else, let me know. Otherwise, I'm going to call it a wrap. Appreciate your